Hi there, I'm David from DB Chartered Accountants. One of the first major decisions that you'll have to make as you start a new business is the form of legal entity that it will take. To a large degree, this decision may be dictated by the way you've organised your operations and whether you intend to work on your own or in conjunction with others. The form of entity you choose can have a significant impact on the way you are protected under the law and the way you are affected by taxation rules and regulations. There are 4 basic forms of business organisation, and each has its own benefits and drawbacks and is treated differently for legal and tax purposes. These are sole traders, partnerships, limited liability partnerships, and limited companies. Sole traders and partnerships have been considered on separate videos. Please take a look at these. In this video, we will consider limited companies. A limited company is a separate legal entity that exists under the authority granted by statute. A limited company has substantially all of the legal rights of an individual and is responsible for its own debts. It must also file tax returns and pay taxes on income and on capital gains it derives from its operations. Typically, the owners or shareholders of a limited company are protected from the liabilities of the business. However, when a limited company is small, creditors often require personal guarantees of the principal owner before they will extend credit to them. The legal protection afforded to the owners of a limited company can, however, be extremely valuable. A cautionary note to the ill-advised: if you don't run your company properly and extract funds correctly, you can effectively strip away the limited liability protection. For example, if you overdraw your director's loan account, it would be problematic putting a struggling company into liquidation if the directors owed it a lot of money. There are legalities to comply with on the setup of a limited company. It must obtain approval from Companies House to use its proposed name. A limited company must also adopt and file a memorandum and articles of association which govern its rights and obligations to its shareholders, directors and officers. A limited company must file an annual return, a CT 600 corporation tax return, with HMRC each year. It's also required to file accounts at Companies House each year and also complete a confirmation statement providing details of shareholders. Failure to file accounts at either Companies House or with HMRC can result in penalties being incurred. Thus, you can't afford to be in arrears with your accounts. Companies House are very quick to threaten to strike off your company if they don't get the documents that they require filed promptly when due. Incorporating a business allows a number of advantages, such as the ease of bringing in additional capital through the issue of share capital, or by allowing an individual to sell or transfer their interest in the business without the business coming to an end. It thus provides for business continuity when the original owners choose to retire or sell their shares. From a tax perspective, the act of incorporation can create advantages. You can sell an existing business or other assets that you own to the company at market value, and if necessary, pay the capital gains tax on it. If the sale proceeds are not paid, then the amount would be owed to you on what is known as a director's loan account and can be used as a means of extracting profit out of the company without tax being charged. You can make savings of national insurance contributions by drawing profits as dividends rather than as a salary. This may result in a personal tax liability to dividend tax, but by using your basic rate band to the best advantage to minimise the tax you pay, This is a key part of any tax strategy used to take money out of a limited company. Tax is payable on any director's remuneration paid via PAYE and is due for payment on the 19th of the following month. Tax is paid by shareholders on dividends under the self-assessment rules, although some dividends can be taken tax-free each year. Please see our video on salaries and the one on dividends, which provide more information about this. Unless profits exceed 1.5 million, which is not likely to bother a new startup business, corporation tax is payable 9 months after the year-end date. Let's look at some of the specific advantages and disadvantages of a limited company. As was mentioned earlier, companies must be formally incorporated. There is therefore an initial setup cost which you generally don't get with an unincorporated business such as a sole tradership or partnership. The accounts for limited companies are more complex than for unincorporated businesses, and the business owners usually need more help and advice throughout the year. Inevitably, accountancy costs will reflect this and thus are higher for limited companies. This, however, should not really be a factor that determines whether you use a limited company or not. If a limited company is right for you, then the additional costs are usually more than worth it. Companies are governed by the Companies Act. Under this Act, a company is required by law to keep accounting records, keep statutory books showing details of shareholders and directors, and file accounting information and confirmation statements with the Registrar of Companies. Thus, some information about your business is made available to the public. Companies may have greater borrowing potential. They can use their current assets, such as debtors or stock, as a means of providing a security by creating what is called a floating charge. Shares in a company are generally transferable. Ownership may change, but the business continues. Incorporation does not guarantee reliability or respectability, but does give the impression of a soundly based organisation. For the business owner, there may be additional prestige attached to being a company director. First-year losses in a company can only be carried forward to set off against future profits. This is not as good as with a sole trader, where losses can be set back into prior years to generate a tax refund. Despite the disadvantage relating to tax losses, limited companies are great for controlling your income in order to maximise the reliefs and allowances in a well-designed strategy created to minimise tax liabilities. Tax is paid initially by the company, then personal taxes and possibly national insurance are payable by the individual directors or shareholders when they take money out of the company. The corporation tax rates are currently quite low, and thus retained profits used for funding future growth will be greater in a limited company, as they don't have to face the higher rates of tax that a sole trader may incur. By retaining profits and carefully planning how you extract them from the company, it allows you a great deal of flexibility and control over how money is taken from the company. This enables income to be taken out of the company evenly over the years and avoid unnecessarily incurring higher rates of tax. It's easier to involve a spouse or a partner in a limited company as a director and a shareholder of the business. This gives the ability to take advantage of more than one person's personal allowance and their basic rate band. You could always do this by making them a partner in a partnership. However, the risk involved in doing this simply to get the tax benefit is not usually, in my opinion, worth accepting. This leads me to the main reason that I'm in favour of all businesses of any substance, or those doing anything that is potentially risky, being a limited company. The main advantage, in my view, is the limitation of liability that comes with a company. As long as the company is run responsibly and in accordance with the rules, and the directors are well advised on their responsibilities, should anything go wrong, then whilst the company itself may have to go into liquidation, the personal assets of the owner are protected. In a society that is getting more and more ready to legally pursue business owners for any liability, limited companies allow a greater degree of protection that allows business owners to sleep soundly at night without the risk of losing everything. Limited companies are undoubtedly more expensive to run than unincorporated businesses. However, the additional costs are often worthwhile accepting as the price of obtaining greater tax flexibility, a significant reduction of risk. Only extremely small businesses who are averse to paying the higher costs should run a business that does not have the protection that limited companies provide. Whilst being a limited company is probably the ideal status for many businesses, when you're in a startup situation, there may be strategical reasons for starting as a sole tradership initially, and then changing to a limited company at a later date. This, however, is where business advice comes into play. Everyone's different with different needs. It's better to discuss your situation with an accountant at the outset to decide which is the best way of proceeding. If you would like to discuss your situation prior to starting up in business, please give us a call on 01 226 245824. We offer a free, no commitment meeting to discuss your situation in which we can consider your particular circumstances so that we can help you to decide which type of business setup is best for you. If you have not already done so, please subscribe to our YouTube channel so you can receive notifications whenever we upload new videos. Thank you for watching this video. Bye for now.